Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone. We've just released our quarterly India market outlook titled Shifting Growth Inflation Dynamics. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India, and I'll be a host for this podcast. It has been an eventful past 4 weeks for the financial markets. The US Fed finally embarked on a policy easing cycle in late September, surprising markets with a higher than expected cut of 50 basis points, driving bond yields lower and boosting risk sentiments. This was followed by China's big bank policy stimulus to support its capital markets and economy. Asian equities rallied strongly as foreign investors increased allocations, though Indian equities came under pressure. Earlier this month, election results in two key states of India showed that Bharatiya Janata Party remains a popular choice, defying popular exit polls. Finally, last week, the Reserve Bank of India surprised markets by shifting its monetary policy stance to neutral with a unanimous vote while keeping the policy rate unchanged with a 5:1 majority. Well, to understand the impact of these developments and how investors can position their investments, we have with us a special guest today, Mr. Vinay Joseph, who heads the investment products and strategy at Standard Chartered Bank India. Hi Vinay, welcome to our podcast.
Hi Ravi, happy to be here.
Well, starting with the most recent one, the shift in RBI's monetary policy stance did come as a surprise, especially given its communication over the past few months. Could you share some light on this?
So the dovish tilt in RBI's policy did come as a surprise, but it's important to note it's not an ad hoc decision. In fact, if we look at data, we would see that on the back of sequential moderation in a number of high-frequency indicators that include industrial production, GST collection, manufacturing and services PMI, while still stronger than its peers, the fact is that this continues to show a slowdown similar to what we saw with the lackluster GDP print and earnings growth in the first quarter of this financial year. And this is what drove the primary shift in RBI's policy stance. In our view, this move affords RBI the flexibility to remain vigilant on inflation, which it expects to surge in the coming months amid food price volatility, but also retain the option to cut policy rates should growth concerns persist.
So, does it mean that an RBI rate cut cycle is likely to begin sometime soon?
As I said, the slowdown in domestic growth indicators indicates that monetary policy easing, especially in the major economies, and the recent dovish tilt indicates that the odds of an RBI rate cut has increased should growth challenges persist.
Well, if we were to, an RBI policy easing is likely to come, would that impact the performance of Indian assets?
Well, that's a very pertinent question, and we did an analysis of the past 5 RBI easing cycles spanning over 2002 to 2019, and we found the following trends. First, bonds historically has been the best asset class on performing around as well as post the easing cycle, with bond yields trending lower as we get into the easing cycles, and they continue to decline over the next 6 to 12 months post the first rate cut. On the other hand, cash yields does witness a decline around the start of the easing cycle, although it is much muted compared to bonds. However, following the next 3 to 6 months, the decline in cash yields does outpace the fall in bonds. Finally, on equities, they have generally trended weaker as we head into the first rate cut, recording an approximate 5 to 6% decline over the 12-month period, not similar to what we have seen in this cycle, but this can be attributed to growth on revenue and corporate profitability being much slower. The performance in the immediate 1 to 3 months tends to be a little bit stronger post the first rate cuts, but as we move into 6 to 12 months with financial conditions easing, economic activity stabilizing, and profit outlook improving, we see a divergence of performance across sectors and investing style. So it depends a lot on what's the macro scenario there for us to see what would be the trends on equity going ahead.
Well, Vinay, with that insight, how do investors position their investments in an environment of what you just mentioned as normalizing growth and also potential monetary policy easing?
So we've been highlighting this since our second half outlook that we see an increased risk of a pullback in domestic equities in the near term. given India's valuations are definitely stretched compared to regional peers, even with the high growth rate which is forecasted. We are likely to see a further normalization of economic and corporate earnings growth. Additionally, we cannot rule out the significant event risk with elections in US and Indian key states with Maharashtra upcoming. Finally, the escalation of Middle East tension and its feed through in commodity prices is a key risk to monitor as we go ahead. So given this framework, our view has been to have a diversified asset allocation to tide through this near-term uncertainty, through an equal allocation through bonds, equities, cash, and gold. For bonds, we are neutral on bonds as highlighted. We expect the 10-year benchmark IGB yield to trade between 6.5 to 6.75 over the next 12 months. Within bonds, we see the scope of declining yields supporting our overweight on medium and long maturity bonds, which would outperform the short maturity bonds over the next 6 to 12 months. Further, what we see with declining bond yields is that you're going to see them helping with corporate profitability being strong, our preference for corporate bonds, especially the AAA and AA plus bonds going ahead. On equities, our view has been positive. Declining bond yields and improving global growth outlook is positive for equities, but this is counterbalanced by stretched valuations and normalizing growth and corporate earnings. For us, the broader markets is clearly a place where there is a little bit of exuberance, with valuations at cyclical highs compared to large cap space, increasing the odds of a pullback. So given this risk reward, we are neutral on equities, and we continue to have a preference for or an overweight on large cap equities over mid and small cap equities, given what we highlighted, a better margin of safety in terms of earnings and valuations. On cash, though cash has been very rewarding over the last 2 years, that period is also coming to an end. And historically, as highlighted earlier, the start of a RBI easing cycle leads to a sharp decline in cash yields over 6 to 12 months, which increases the reinvestment risk. This is one of the reasons why we prefer bonds over cash. Finally, don't forget about gold. Gold prices still has room to rise further. Declining bond yields, central bank purchases, and strong domestic demand during festive season amid a decline on import duty are key supportive factors. We prefer gold as a solid core holding and a portfolio hedge against escalating geopolitical tensions, commodity price shock, or a general global growth slowdown.
Well, this brings us to the end of this episode. Thanks, Vinay, for the detailed insight. It is always a pleasure to have you on a podcast.
Thank you, Ravi.
Do reach out to your relationship manager for a copy of our India Market Outlook. You can also find it on our website on the Standard Chartered Market Views on the Go page or on SC Invest section at www.sc.com/in.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.sc.com/in.